In this video, we're going to be performing a deep dive on Chubb's dividend safety. To begin, let's talk about Chubb's business model. Chubb is one of the largest domestic property and casualty insurers with operations in 54 countries spanning commercial and personal P&C insurance, reinsurance, and life insurance. The company was founded in 1882 as Chubb and Sons in New York City, and since that time, it has grown into a sprawling conglomerate, with its latest edition taking place when it merged with ACE in 2016. With operations in 54 countries and territories, Chubb is a major international personal lines writer, as well as a leading middle market, small commercial, and large industrial commercial insurer, providing a wide range of traditional and specialty coverages. Chubb is a well-known dividend stock because of its compelling trade record of dividend growth with 25 years of consecutive dividend increases. Chubb is a member of the Dividend Aristocrats Index, a group of elite dividend stocks with more than 25 years of consecutive dividend increases. Looking ahead, Chubb's lower dividend yield may not attract income-focused investors. However, its low payout ratio and growth momentum make it look more attractive as a long-term income growth investment. For the remainder of this video, we will discuss the company's current dividend safety from four perspectives. 1. Its dividend safety in the context of its current earnings. 2. Its dividend safety in the context of its current free cash flow. 3. Its dividend safety in the context of its recession performance. 4. Its dividend safety in the context of its current debt load. First, let's discuss Chubb's dividend safety in the context of the company's current earnings. When Chubb announced its fourth quarter financial results on February 5th, the company reported that it generated earnings per share of $8.49 for the fiscal year. For context, Chubb paid $2.90 of common share dividends during the same time period for a dividend payout ratio of 34.2%. Using earnings, Chubb's dividend appears very safe for the foreseeable future. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Chubb's current dividend payment to its free cash flow. In fiscal 2018, Chubb generated $5.48 billion of cash from operating activities and had zero capital expenditures for free cash flow of $5.48 billion. The company distributed $1.34 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 24.5%. Using free cash flow, our conclusion is the same as when we used earnings to measure Chubb's dividend safety. The company's dividend appears safe for the foreseeable future. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Chubb's current dividend safety in the context of the company's historical recession performance. We believe the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Chubb's performance during this time period is shown here. Chubb's earnings per share declined by 53.9%, peak to trough, during the last recession. More importantly, however, thanks to the low payout ratio, the company's earnings continued to cover its dividend, and it continued its streak of consecutive dividend increases. Accordingly, we have minimal concerns about the company's ability to pay rising dividends during future economic downturns. The last angle that we will use to assess Chubb's current dividend safety is by looking at the company's current debt level. More specifically, we will see how much the company's weighted average interest rate will need to increase before the company's free cash flow will no longer cover its dividend payment. During fiscal 2018, Chubb generated $621 million of interest expense and had $12.9 billion of debt outstanding for a weighted average interest rate of 4.8%. The following image shows how changes to Chubb's weighted average interest rate would impact the company's dividend coverage as measured by free cash flow. As this image shows, Chubb's weighted average interest rate would need to rise above the 35% level before its dividend would no longer be covered by free cash flow. Accordingly, we believe that Chubb's debt level is unlikely to impact the safety of its dividend moving forward. Thank you for watching today's video, which performed a deep dive on Chubb's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.